Today's market call is brought to you by MoneyLion, the first digital ecosystem for consumer finance, empowering everyone to make their best financial decisions. There's people on this October. Oh, look at that.
What?
That's like, I'm just noticing this. A little clock in the bottom.
It's been there for like weeks.
No, I mean, I got to pay attention. Cheapest thing you can do. It's Swizzle here. I look big. I got to move back. It's 11 a.m. on the East Coast on October 28th, Tuesday. Bill and Dan were just talking about the Dodger game last evening. It went 18 innings, which is insane.
I was up for 14. 14 of the 18. I turned it on in the 5, in the 5th, and I just literally couldn't do any more and the 14th. But I'm sure that they felt, yeah. I mean, it seemed like no one was ever going to score, and so I just kind of said, you know what? But to see that walk-off situation, which was fascinating. Guy, today is one of those days where, the market's unchanged. I mean, it's just unchanged. It's basically, up 10 basis points. A lot of news out there, though. A lot of newsy stuff. We got a lot of news,
a lot of earnings, a lot of excitement around certain things.
What are you excited
I just
about?
saw Ray Dalio speaking to Sarah Eisen. I believe they're in Riyadh. He's talking about, Sarah obviously asked him about bubbles because that's top of mind for a lot of people. And, he was quick to point out that, bubbles typically pop in when financial conditions are tightening. However, what he said was, he has a bubble indicator, and I'm not paraphrasing. I think he used that phrase, and it's elevated. I think it's the term that he used. So, I mean, he sees things that are, again, it goes, a lot of people are saying the same things. It's funny. Andrew just wrote that book. He was making some corollaries to the late 1920s. He compared some of it to the late 1990s. But everybody's also quick to point out that just because it appears that way, things can last a lot longer than most people think. And as we sit here at the end of October, which is unbelievable, we're about to be, we'll have November's next week. The chase is clearly on, and the chase is going to be on for things that people feel they can get the biggest bang for their buck. And so it can continue. And that's not to suggest I'm bullish. I'm not. That Buffett indicator is now approaching 220%. Cyclically adjusted price to earnings ratio, the Shiller Cape ratio, I think is north of 40 now. Second highest reading ever. I mean, Doug Cass pointed that out in a note. So all these metrics, which are not timing indicators, but, are definitely metrics you have to watch, have been and continue to be flashing warning signs.
Yeah. I mean, listen, I can be labeled whatever. I know that Dalio, and I don't put myself anywhere in the same, stratosphere as Ray Dalio. He's made gazillions and gazillions of dollars for investors.
A lot of gazillion, right?
A lot of gazillions. I think we are setting up for a collapse of epic proportion, whether it comes in 26 or 27. I mean, some of the things that are going on here is like nothing the world has ever seen from an investment standpoint. You can make all the comparisons as you want to the late 90s and what happened, obviously, over the next few years in 2000 into, the lows in 2003. This is so financialized, Guy. I sent you an article from The Information today about this structure, and we've been talking about it, this $27 billion data center structure that Meta has contracted with a company called Blue Owl. It's a private credit company. They're going to put up $2.7 billion in equity, and then they're raising the debt from Blackstone, from BlackRock. All that debt, or a good part of it, is going to make its way into ETFs. Meta does not have to put the debt on the balance sheet. They don't even actually own more than 20% of the data center. It's a 20-year lease. First of all, the debt is 2049 debt. Okay. It's got a 6.6% coupon, which is a percent. It's basically a junk coupon, right? For something that's like AAA rated or something like that. All right. And so they need to do that to entice folks. There's 4-year segments of this lease. Okay. Normally you'd have to depreciate this lease and carry it on as a liability with the debt, right? So they can get out of it like every 4 years. Just think about that. If they can get out of this data center, who the hell is going to buy or lease this data center if Meta doesn't want it? Okay, so you got all these, and all that is in an SPV, a special purpose vehicle. So like that is about as clear as mud. if you're an investor looking at something like that, right? And so Meta is not on the hook. All these other folks that are going to be on the hook. So again, that's just what's happening right now. But you think about how financialized this theme is right now, the vendor financing, the circular, like all this stuff going on. I mean, at some point, guy, when the bubble bursts, and no doubt about it, I mean, this thing can stay irrational longer than you can stay solvent. Some point, there's going to be nowhere to hide. I mean, there's just nowhere to hide because all of this, think about the percentage of our GDP that it's worked into. So again, that is what it is. I'm going to give you another example of a stock in a few minutes because I'm going to shut the hell up. But today it's just like this rotating. It's like a shell game. So today the news, let's just throw up Microsoft for a second. Okay. They finally get some disclosure on what their holdings are going to be of this new OpenAI entity. And part of the deal, look at that from Street Account. And part of the deal is that OpenAI is going to spend another $230 billion on Azure, on their cloud service. So once again, it's this kind of circular nature, guy, of all of this, this whole theme.
Every day a new story seemingly, and you have Microsoft. I think it's not at a new high today, but I think it approached one. I think the all-time high was 555 and change. We got close today. So that's, by the way, headed into an earnings release. So we'll see. And, one thing, I don't take a lot of solace in many things, but I will in the following, that for the last couple of years, we have correctly pointed out the importance of passive investing. And now over the last couple of weeks, seemingly it's written about not every day, but seemingly every other day. It started with Torsten Slok, but a lot of people, I saw it today in whatchamaface. What's the name of that account that I like? Zero Hedge. And they're talking about the distortions that are being created by passive investing, and it's true. And what we have pointed out now correctly is the fact that passive investing cares not about any of the things that we talk about on a daily basis. The money flows in regardless of circumstance, news, valuation, you name it, doesn't matter. And that's great on the way up. Of course, what it does, though, is creates these historic levels of valuations and a lot of different things. By the way, not least of which the broader market, which probably, even with better earnings, is probably approaching 23.5, 24 times forward earnings, which is pretty historic if you go back and look. So as you like to say, have at it, people. I don't know what the catalyst. I'm hard pressed to believe, especially the later in the year that we get, the more the chase will be on. But I'm still of the belief that before year end, you're going to have a few days where the volatility index is a story, and then subsequently means the market's probably a story as well.
Yeah, I mean, the flip side of that is that, we get this headline. You're looking at the S&P right here. We have a couple gaps in the last few trading days, and it's like the China deal. And, the China deal is literally bringing us back to where we were prior to early April when we rolled out. And so the fact that investors just buy into some of this nonsense, I mean, literally whatever deal that is agreed upon, right, by President Xi and President Trump in the next week or so, literally brings us back to where we were on April 1st. I mean, it's so, we create this problem. You say this all the time, right? You kind of, you light the fire and then you come in as a fireman and you take a lot of praise for that sort of, I mean, whatever. I mean, I'm not rooting against the market, and I'm not rooting against America, but man, it just seems like there's so much headspace that we are spending talking about putting out fires of our own creation, and then I think a lot of investors have looked by it. And when you go back to, April and May, the one class of investors that didn't look by it, did look, were retail. You know what I mean? And so that's great. I'm super happy that folks are making a lot of money in this market. And then when you think about it, I'm going to get to some goofy stuff that's going on right now. But if you talk about how long, the bubble can go, I mean, I'll just say this. If everything in our lifetime have been accelerated in the last 30 years or so, like all these cycles, whether economic cycles or market cycles or whatever the hell you want to say, there's no reason to believe that this bubble, the inflation of the bubble, shouldn't pop quicker than what we saw into the 2000, right? Into the financial crisis, whether real estate and that sort of thing. So I just think we're hitting like a major like level of euphoria that we have not seen, Guy. In 30.
And you say no, we're not rooting against anything. And I think it's un-American not to point out some of the concerns that we have. Now, the concerns, quite frankly, my concerns have been unfounded. The problem, of course, is the concerns haven't gone away. It'd be one thing if I had those concerns and they subsequently sort of went away. The problem, of course, is the concerns are still there. In some cases, concerns are greater, but the market has a way of sort of drowning it out. So, I mean, that's not being nuanced. I mean, that's just what's going on. And that to me is somewhat problematic. And, I lived, I've been doing the show long enough. And as you pointed out, I started working in 1986. So I've seen enough of these things where the aftermath is such where people say, I wish somebody had sort of pointed this out or wish somebody pointed that out. And, I guess just in the wake of that, I've been trying to be the person that's trying to point these things out. Now, of course, pointing them out has been wrong in terms of directionally for the market, but it's no less important to do so.
Yeah, let's just quickly hit the QQQ, and then I want to hit a name that's like today on my bubble watch here a little bit. So Peter in the book report, this is Peter Bookvar, had a great comment here, and let's just, let's break it down for a second. Just a heads up, the Nasdaq 100 is now almost 18% above its 200-day moving average. As seen below, it is the most since July of 2024 when it got 20% right before a 13% correction, just as gold got very extended and currently in the midst of a shakeout. The NDX is now going vertical. So thoughts there, Guy? Do you look at some of those, standard deviation sort of stuff here? Is this important to you? As
you have to, and it is a mean, there is a mean reversion to this. And again, listen, we can just play the game if you want. You go back to sort of June of 2024, you see, that's the 20.13. You see what subsequently happened. We traded down to the moving average and bounced. Then you go to maybe December-ish of that year, same type of thing. We got up to about 14.25%. And bounced. Now, what he didn't point out, but it's worth pointing out, if you go to March, April, we had a standard deviation probably approaching 18.5%, 19% to the downside, and then we subsequently traded back up to it. In this case, though, we didn't stop. Now, here we are, 13.5 past that, approaching 18. There's an inevitability to all this stuff. There is an inevitability to mean reversion. It can last longer than you think, but you're starting to talk about now, when was the last time? April-ish. So you're getting a little long in the tooth in terms of duration as well.
Yeah, I'm just looking at this and I see that 50-day moving average, guy, it's about 593. I am long of the November 625 590 put spread. It cost about, I want to say $5.50. So just think about that. It's the strike, the 625 less the premium you pay. Let's just round it, right? $5. And so your break even is at 620. If the stock or the ETF in this case is between 620 and 590, you can make up to, you can do the math there, $30, right? So I'm risking, let's say 5 or 6 to make possibly 30, but to get a move down to 590, that's considerable. But you look at that 200-day moving average all the way down there. So you get the point. All right. So here's today's example of why things have gone, I think, batshit fucking crazy. So here's a stock that I've known about. This is a contract manufacturing stock or electronics manufacturing stock. This is kind of in the nuts and bolts of any major hardware build out. It's called Celestica. And it's not a name that most folks in the tech space give a lot of thought to because it's not that interesting of a company, right? So a company like this, they'll work with one of their customers. In this case, let's just talk about Alphabet, a 31% customer. Amazon is 13%. Dell and Hewlett are combined 12%. So they have 4 customers that are nearly 60% of the revenue. Go back 5 years for a second. So these are not particularly interesting businesses when you don't have some major theme. It's a 12% at best gross margin business. 4 years ago, they had like 9% gross margins. All right. So you can do the math on increased profitability, what that, what the revenue growth rate and what that flows through to profitability and the like. Okay. So this stock, since ChatGPT, was announced or launched in late 2022, the stock is up like, I don't know, 5,000% or something like that. Okay. It's up 260% on the year. It's got a $38 billion market cap. The margins, as I mentioned, have been going up over the last few years ago, as you've seen revenue start to inflect a little bit. All right. So I just want to kind of hit something here. So right now, revenue growth, Guy, they just raised guidance this morning for 2026. Okay. But right now, revenue growth is expected to be, prior to that guy, 23% year over year. In 2027, about 20%. So they guided up 2026 a bit. But again, let's remember 12% gross margins. EPS is, it's been all over the place. In 2023, it was $2.43. Then it was $3.90. Then it was this year expected to be $5.60. They guided up a little bit. I think they guided up to $5.90, and then next year $7.13.
$7, yeah.
Okay, so just think about a company, even if they're growing, let's say 30% earnings, right? And they're growing revenues, let's say 30%, but they have a 12% gross margin. So now you have a stock trading at a multiple that it has not in a long time. You would say that this is a commoditized sort of business, low margin, and it is, okay? But when you look at the performance of this stock, what investors are willing to do. So this company basically designs servers and racks for Alphabet, for Amazon, for Dell, for Hewlett. They sell them switches that connect them all, right? And they do, a handful of other stuff in the data center. And so this has got now a $38 billion market cap, and it's trading at a multiple 50, 60 times, next year or something like that. And then let's just look at the chart now, a 1-year chart for a second. I mean, you see what's happened off of those lows, okay? So I look at this and I say, up off the 500% off the April lows, 3,000% from the launch of ChatGPT. Now let's do a 1-day chart here. And I promise I'll shut up. So, it's given, if it fills in that gap, guy, okay, let's go back to a 1-year. I mean, what does this mean for, we talked about SanDisk and Seagate and Western Digital in the storage space, right? Look at SanDisk for a second, SNDK. You see that it's kind of reversed that move over the last couple days or so. I mean, so talk to me about some of these patterns. I mean, these are names that are not well followed, but they're important because this is what investors got late to. This stock, we said this yesterday, has rallied from 50 to 100 and whatever it was, 85 in 2 months.
Well, the thing about these companies, you just mentioned it historically, specific. So the one CLS you mentioned is sort of new to me, but SanDisk obviously and Western Digital not so much. And historically, highly cyclical, highly commoditized companies that have sort of peaks and troughs of their stock price, which makes sense. Now, something obviously changed over the last, specifically for SanDisk over the last few months, but all these names. And what's changed, obviously, is the market no longer viewing them through that lens and viewing them as some sort of growth engines or growth vehicles that are going to seemingly have that type of growth in perpetuity. But what we have learned the hard way is that typically is not what happens. And they're not only seeing it in terms of SanDisk and in terms of Western Digital, but a company like Micron, which historically has been very cyclical as well. What the market participants are saying is those old paradigms in terms of cyclicality and the potential to be commoditized no longer exist. And I just don't think that's true. I don't think things change like that. But the market is saying exactly that right now. Again, I don't know what the catalyst is going to be to sort of get people on more solid footing and a better understanding, but it's out there without question. And, you mentioned the margins. It's just a matter of time before I think the market comes to the realization of, wait a second, these are not deserving of the premiums that we're putting on.
Yeah, and the other point about these sorts of names, so if investors are coming to them this late, and there's a lot of smart tech investors out there, they have like all these matrix and all this stuff, and they're looking at all this stuff and the interplay and the valuations and this, that, or whatever. They've been on these things and they love it when retail gets involved. And listen, man, I wish I threw a dart. I wish I was more focused. That this was my primary game, just looking at this sort of stuff, because there were, fortunes made by finding some of these stories and having some conviction and risk managing them and that sort of thing. But I'll just tell you, with a Celestica, I would have sold it 10 times over, and I just suck. Okay. So all the power to you guys who could buy something like that and hold on to it. So, that is what it is. And just on some of these names, I think it's important because, on a day like today, we see the S&P and the Nasdaq up a little bit, but Doug Cass is pointing out how poor the breadth was yesterday, guy, and how it is again today. And maybe Amanda can flash this up a little bit. He sent us an email. He said that breadth was flat negative in both the NYSE and the Nasdaq yesterday. Today, so far, negative breadth nearly 3-1. Yet indices, thanks to Microsoft, are higher. And again, that goes to the concentration in the major indices. So thanks to Doug, our friend. From,
we talk about internals all the time. I mean, and it's worth watching historically. when you watch the market internals, they're going to give you a clue as to what's going to happen next, which again, I still believe to be true. But as Doug would tell you, and I think I've come to the understanding that, yeah, market internals are important, but we see these. This is not the first time we've seen internals like this. Negative market internals, and the market doesn't seem to care. Now that speaks to the top heaviness of the market that we've been talking about for a while. People will continue to say there's a broadening out, but when you see something like this flashing in front of you, it's pretty clear that it's not broadening out.
Yeah. Guy, we have a great partner. It's called Moneyline. This is a marketplace. Yeah, they're a great sponsor of ours, great friends of ours. And they offer a marketplace for lots of different financial services companies, but they also have a great newsletter. Maybe Amanda can flash that up. And every once in a while we take questions from some of their customers, and there was one that I thought was really interesting that I got yesterday, Guy, and it's somebody who watches our shows and subscribes to our newsletter, their newsletter, and they do a great job linking to a lot of really good resources that a lot of individual investors or people who are just focused on self like dealing with their own finances, that sort of thing. But the question was from a reader suggesting that the market to him is getting very overheated. He's participated a good deal in some of the themes and individual stocks that have been part of the narrative as it relates to AI. But he's starting to get a little nervous and piecing out, as we say on the trading desk, piecing out of some of these positions.
Eating the ducks, we used to say.
There you go. But he doesn't want to be totally out of the market as he gets rid of some of the idiosyncratic risk in individual names. Okay, idiosyncratic individual, that sort of thing. And so he asked, how do I maintain a certain level of exposure to the market, okay, without kind of going all in again? So get rid of the single positions, but getting too much exposure to the major indices. And so my suggestion, and I think I'm going to know where you're going with this, is as you piece out of those, you start putting money little by little in the major indices. Now, to your point that you just made, because of passive investing, you're going to have a lot of exposure to, let's say you were in Microsoft, or let's say you were in Amazon or Meta, that sort of thing. But at least if you're dollar cost averaging, let's say you buy a little here, the market goes down 2%. Next week, you're buying a little there. Next week, it goes up 1% from there, whatever it is, right? So you're basically going to average into a price. And if you're viewing things longer term, right, and you don't want to be exposed to individual names, dollar cost averaging in a major indice makes total sense to me. Obviously, there's lots of ways to skin that cat. Low cost ETFs like the QQQ or the SPY are probably pretty good ways.
No, it makes sense. Obviously, this individual has done well with certain specific names. He or she feels as if it's getting a little overextended. They want to remain in the market. The way you just described is a way to do it. It's probably the right way to do it. Pair out of the individual names and then start to sort of layer into broader market, whatever that is, the Qs, the SP, whatever the hell it is. You could also do it the following way. You could say, you know what? I actually think it's clear that I've been right in my views on these individual names. I'm getting a little concerned. Then you can ask the question, okay, if this thing is going to turn and if my fear is warranted, what is going to be the rotation into? So instead of going broader market, you can say, you know what? The market will rotate into X, whatever X is. Healthcare, the market will rotate into energy. The market maybe rotate into some of the, I don't know, historic, maybe boring tech names that we've talked about from time to time. Problem, of course, is some of those boring tech names have done extraordinarily well. Boring tech historically has been IBM, Oracle, Cisco, you name it. No stocks have done well as well. Yeah. But I think there's a rotation that's going to take place. And if you want to sort of play that game, try to figure out what the rotation is going to be into. Again, I've thought energy for a while. That's not been correct, albeit a couple individual names have done well. I've also thought healthcare is going to be a thing, which is showing signs, but that's another way to do it as well.
Yeah, and I think it makes sense to think, when you're looking at healthcare or you're looking at energy, and there's certain different, attributes of each one of those sectors that make some sense in different economic environments. The one thing I'd say is be careful with like a consumer staples, or we used to say with like utilities, but utilities now boring have become part of this AI trade, right? So there's fewer and fewer places that look defensive in the stock market, and then staples, they might look attractive because the dividend yields relative, with rates going lower or expected to go lower. But again, to me, sometimes rotating into the places that are basically deemed defensive, that's maybe more of a short-term thing, but I get it. I'm more in favor of dollar cost averaging SPY or QQQ. And that is what it is. All right, Guy, let's talk about gold. In Peter's note, he talked about this sell-off that's going on there. I think
we have a couple of questions. I'm glad you brought that up because there's some questions as well.
Let's hit the questions and then we'll go from there.
Well, the questions are, they're varied, but they're all basically saying the same thing. Is it time yet to get back into gold? What's going on with gold? Along those lines, nothing specific other than gold questions. And what I've said, and I think you've said this, listen, Carter talked about this a week or so ago, so his timing was unbelievable. He thought it was time to sort of take some money off the table. And we had discussed, again, in terms of the stochastics, in terms of the overbought conditions, through a number of different metrics, it was inevitable that gold was going to have a move of this magnitude. Now, if I'm being honest, I thought what was going to sort of set this in motion was a broader equity market sell-off that gold would not be impervious to. That was incorrect, obviously, because the S&P made a new all-time high today. So gold, for whatever reason, found its way lower on its own. I also have been saying that there's going to be a day where we open down $100 or so and reverse. Now, if you look at today, I'm not saying it's going to be today, but today is indicative of what I'm starting to talk about. Gold sort of open on the lows. If you look, well, it's open around the lows and it's been grinding higher ever since. So if gold were to sort of fight its way to unchanged today, that could be sort of, aha, let's take a look at this, because then it could be enough damage has been done to the downside where it's going to start to reignite. And I think today is a day you absolutely want to keep an eye on.
Yeah, let's pull up the GLD because it's going to look a little differently because it's not a continuous sort of future chart here. So one of the things that I find interesting, different patterns. So go to 1 year for a second, and then we'll go back to this. This whole idea that we've had a few consecutive gaps lower. What is a gap, right? So you close at a certain level the prior day, and you see the gap between the close and the opening here. So, and obviously, like in an ETF that's tracking the underlying, and gold, GLD, I know you don't always love relative to the future, but just as a lot of ways that a lot of people get exposure. We like the futures because the way you can set stops and the like, and the leverage is something interesting to a lot of people. But I like the idea. Now let's make this like a 1 month chart for a second, if you can. So that breakout happened in like 2.5 months. Okay, let's tighten it up just a little bit. So what Guy was just talking about, all right, so look at that gap. And now we're trading at the high of the day today, right? So we gap lower, high of the day. If we were to fill in that gap, and then let's go back to that other chart, the 1 month, it's going to look like something like a spike, right? So that bar is going to look like a spike. And so that is a great formation, especially if you have sort of high volume. You see what's going on here. We've had three consecutive close. We're closed on the low of the day here. So Guy, if we were to close on the high of the day, the expectation is you'd get follow through. And I think that's what you're talking about.
That's exactly right. You're going to start to reverse the trend that we've seen over the last week and a half or so. Again, what we have said is the broader move is not over by any stretch. We needed to sort of hit the refresh button, which I think we've done. And if you have a day like today where it grinds the remainder of the day and closes unched to slightly higher, I think that sets up for the next wave in the gold market. That's just me. So we'll see. By the way, that could coincide with an equity market if the equity market were to do something. Obviously, you just mentioned it before. The S&P is basically, what are we up, like 2.5, 3 handles?
Yeah.
We made a new all-time high earlier today. I think it almost printed 6,900, probably a couple handles short, but here we are. So keep an eye on today in terms of what the S&P 500 is going to do. Do we start to give it up as the day progresses? And, what kind of an outside day could we potentially setting up for there? So that's worth watching as well.
Yeah, I guess also keep an eye on the headlines if there's any tape bombs around a China, U.S. sort of trade deal, if that goes the opposite way. I think a negative headline, Guy, the S&P is down 1% in a straight line, maybe 1.5 or something like that. But who knows? We also have this Fed meeting this week, so that'll be interesting. I just want to highlight a couple names that reported overnight, Guy, that I think the price action is interesting. Let's start with UPS, and I know this is one that, you've
worked there.
Well, you did work there. Are you wearing brown right now? No,
I am.
Okay, let's see what brown can do for you.
I just sort of kept with the theme.
So I want to let's pull up a 1 year UPS because this is one. Well, look at this. Look where the low was from April. right? And look at those 2-day, the gaps in late July, right? And you see the stock, it was kind of like trying to round a little bit. Look where, if Amanda wants to just draw a horizontal line from the April lows, I mean, that $90 level, look at that. Pretty interesting, right? So now let's kind of look where it stopped, right at that 200-day moving average. Now let's
we also stopped, by the way, right at the 2020 low-ish, I think. If you go
really?
back to April, yeah. Years. So if you want to do longer term.
Yeah. Well, look at you.
Yeah, listen, I pay attention. Cheapest thing you can do.
It is. But that's a pretty fascinating. You see that downtrend. You see where it stopped today. You see that gap back towards 90. You know, if it holds here, now let's just, again, let's go back
to the prior chart, because there's a downtrend line that we're right up against here.
Oh, yeah. Yeah, maybe she wants to draw that. She's like, well, maybe I'll draw it, guys. Maybe I won't.
No, she's gonna draw it.
Maybe
that's what she does.
As many.
But it's close enough. You understand what I'm looking at. I mean, you move it up a little bit. Yeah. I mean, you can tighten that up. Tighten that bitch up. But you see what I'm looking at. So right there.
Yeah.
Ish.
Speaking of bitches, when are you taking the bitch down?
Yeah, tomorrow, actually.
Really? And for any of you guys who don't know what that means, we're not talking about anything.
I'll get my haircut.
Like that. That can be misconstrued. When you
of course it can. I mean, of course it can be misconstrued. I mean, everything in today's world can be misconstrued.
We give a lot of
the most innocuous things are misconstrued.
Nothing here is investment advice, and no female dogs were hurt in the construction.
No dogs, period.
No dogs. Period.
I mean, you have to put a qualifier on it.
All right.
Although I got to tell you something.
Yeah.
I know you don't care.
I care.
My big dog pissed me off this morning, without getting into great detail. Flip.
Love Flip. Flip's been on Fast Money before, by the way.
He was a puppy when he was on Fast Money.
Flip got underfoot, and I'm not going to dox anybody, but it was an accident in the Adami.
No, Flip didn't. Oh, when he was a puppy.
Yes, he got
Linda Snow. Yes. Yeah, she got tripped by him. It was I don't even want to rehash that.
No, I know, and we love Linda, so we hope she's doing okay.
No, she's fine as well.
So, all right, let's put a bow on UPS. It's up 8%. It's come in off those highs.
It should stall here. A big volume day, but this is worth watching. I mean, that downtrend line is still intact. I don't think the company has fixed itself, but if we were to get a close sort of above that moving average, then we could be having a different conversation for the first time in a while. UPS made its all-time high 4 years ago, if you want to really go farther out and take a look, which is
insane,
unbelievable if you think about what the broader market has done in that period of time, what the economy has theoretically done in that period of time, and how shitty this stock has been that period of time. And most of it is UPS specific. So again, I don't know if it's changed yet, but it's damn close.
All right, here's one that I find interesting for a couple reasons, and it's not too different. Leave a 5-year up and then put PYPL, guy. That's
the PayPal.
Yeah. So EPS beat, earnings, sales beat. So just that was a COVID darling, right? And maybe even go further back. I mean, it's pretty fascinating. This stock looks like the way a lot of Nasdaq stocks in the late, into 2000.
Yeah, it looks like Zoom, probably looks like Snap. Like a lot of those charts are exactly the same. But you brought this up, and you're correct too, because what we could be on the verge of, if you go to the prior chart, is a bearish to bullish reversal. Now, it still needs to do some work. You probably got to get it through the highs that we saw in late 2024, which is probably north of $100. And you'd be like, my God, that's eons away. But, if this thing starts to accelerate, there's a gap in the chart going back to early 2022 that could potentially be filled. Then if you really want to get crazy, late 2021. But let's walk before we can crawl before we can walk.
Yeah, so they're boosting guidance, which is great. But I think more importantly, PayPal is going to be a part of the OpenAI wallet. So this is one of the first payment systems that they're integrating.
I love the OpenAI.
Well, if you're watching where their product roadmap is looking, I mean, this is going to be something where there's going to be a lot of integrated apps, and there's going to be lots of different ways to kind of pay for e-commerce and a whole host of other things. So I think this is a nice nod to the platform that they built, the technology that they have. This is a company that's growing earnings at 11-12% a year, mid-single digits revenue growth, gross margin about 46%. That's down from about 55% 4 or 5 years ago. So if you could see be a better path to profitability, this stock should start to work, trading at 15 times this year, 13.5 times next. So this is one of the ones where it's hard to figure out what it's rallying on the most part, whether it's the upgraded, guidance, or whether it's the potential of the OpenAI thing, because we just spent, 10 minutes earlier talking about how investors are looking for different ways, right, to express themselves with this theme. And it's been my view that the next leg of this, the way that you're really going to actually be able to make money in the next few years, is that if these use cases emerge by companies, whether they're integrating the technology, licensing the technology, it's not just the internal productivity gains, but it's stuff that they can actually expand their market share or take market share, or that sort of thing. That's going to be part of it, and maybe PayPal is part of this story, Guy.
Yeah, well, you've thought for a while that that'd be a nice tuck-in for somebody, I think. So we'll see. By the way, you mentioned Better Something, of course, the great song Better Man by your favorite band. Can't find a better man.
What album, Guy? What album?
10.
No, this. You know this, by the way. It's Vitology.
And 1996, I believe.
Correct. Right? You once told me.
Yeah. Vitology. I remember listening to it.
Was in 91.
No, actually, I do remember.
Versus was 93. Vitology was actually 95.
95.
Yeah.
Oh, okay.
And Corduroy's on Vitology. This is a great album.
That's a great album. By the way, speaking of Better Man, Jack CF, I think that means like Jack Cool is bleep, but what do I know? He points out that, and I didn't see this, but pull it up on the screen here, man. KBW apparently downgraded Berkshire Hathaway yesterday. I didn't see that, but I do have thoughts. So I think this is what KBW is saying. Berkshire, which now has, I think, 35% of their market cap in cash, with each passing day that the market goes up, the market is penalizing Berkshire Hathaway for basically not participating in this rally. So you can read into that. This is just my opinion, that what KBW is saying is the broader market rally is going to continue. And if that's the case, Berkshire is not going to trade well. I'm of the other belief that at some point the broader market starts to fall on the sword a little bit. And I think in that scenario, I think Berkshire Hathaway is going to do very well. So I think Berkshire Hathaway could be a version of the volatility index. So if you think the market keeps going up, the VIX keeps going down, as does Berkshire. If you think the market stalls and goes lower, VIX goes up, Berkshire Hathaway goes up. Back to you.
All right, let me ask you this though. Okay, I mean that makes sense.
Coherent, cogent.
Yeah, I mean, it was very all of the above. You know what I mean? Jack CF. Jack's here a lot with us.
Yeah, my question
for you on Berkshire,
cool as
AF. No, that's not CF. AF.
Well, yeah, that's true.
Do you think though that Berkshire, with all that cash, deserves to trade at a market multiple or above a market multiple? Like that's where it is. And so, like, you take out, so I get maybe kind of the idea is not, it's Buffett and his ability to get good deals in bad times, his ability to get good terms and good time, all that sort of stuff. But with him gone and all that cash,
and lose the old man.
Yeah. Yeah. I mean, that's Sonny.
You make that deal, Sonny. It's easy for you to say. He's not your father. I was just as much a son to him as you and Mike.
Yeah.
Notice he didn't mention Fredo. I pointed that out before.
Fredo's an afterthought. I mean,
no, but that's I was just as much a son to him as you and Mike. He didn't mention Fredo. I mean, that's genius. I don't know if they intended that or not, but it was brilliant.
Well, Fredo was out in Vegas doing something to cocktail waitresses.
Banging cocktail waitresses two at a time. Players couldn't get a drink at the bar.
He's going to say, every once in a while, we got to straighten him out. Straighten out my brother. Okay,
so
we should stop this. It's so good.
Amanda, I don't know if she can chime in or not.
Guy, I don't know
Amanda's
why.
Ever seen the movie. Liz Thomas has never seen it.
I don't. It's embarrassing. I don't know why I'm so fascinated with SanDisk,
Italian heritage,
and Celestica. I mean,
because I'll tell you why. Because you understand this stuff. You understand again their ability to be commoditized, the cyclicality that they historically have traded under, and then you watch them go parabolic the way a biotech stock does, and you're like, this should not be happening. And you're right to point that out. But people will say, you know what, Dan, you know what, Guy, you're missing it. It's different. It's not effing different this time.
Yeah.
Only the names have changed.
And I started out by saying this, and I'm not trying to freak anybody out or anything like that. I mean, you know, a lot of folks who watch us on the Fast Money goes, yeah, he's a perma bear. He's been bearish since 09 or this and that, whatever. You said something interesting today. And I think if you're still here listening to us, watching us after all these years, what we've been doing this, you kind of get that, like, you know, part of what I learned in the business right out of the gate is like, if you have a view, let's say a bullish view, because 90% of the views in the market are bullish views, then you really should understand the other side, right?
Always.
Idea. And, you know, that's what I find intellectually interesting. Now, I know a lot of folks say, oh, perma bears, you know, they think it's so much smarter to be, you know, that. And, you know, and every once in a while, they're going to be right. That's not my point. I mean, you and I create a lot of content. We're in the markets. We do a lot of the same things that you guys do. But for the content purposes, we're not here to give you the next pick to click, the next trade, you know, the next stock to buy or this and that, whatever. We're here to kind of work through we're here to work through a lot of this stuff to help you make hopefully better decisions, thinking about things in a more critical manner. But the one thing I'll say is when this thing blows, it will be of epic proportions. And if you think about that, the market has been cut in half 2 times in the last 25 years based on bubbles that have inflated, where investors at times like this were throwing caution to the wind, okay? Like that this could never stop. The thesis was so ironclad, right? But the idea that this is all going to be on the come, it's all going to happen, you know, at some point in the future, that's the thing that's kind of scary. You know, people thought that housing values would never go down. They could not go down in the United States of America. That this new technology, the internet, that no one was using in 1999, for the most part, single digits % of the global population, was going to transform every industry globally. Well, it did eventually, but misallocation of capital caused these bubbles to burst. And when they burst, the markets got destroyed. I don't know why people don't think that can happen again. I don't know.
Yeah, I'm with you. By the way, Doug is pointing out, Guy, you are wrong. It was 1994 vitality. Sorry, Doug.
Man, you know what, Doug? He could play that game with you and Tim in a heartbeat. By the
100%.
way, all right, but all right. So Doug, 91. 10, 93 versus 94 vitalogy, okay, 96 yield. Yield. I was in college from fall of 91 and I graduated in spring of 95. And just think about, I mean, Pearl Jam was like the soundtrack of my college. And it's 30 some years later, Guy.
I love the Pearl Jam.
There's no the. It's not like the Eagles. I know you love the Eagles.
Well, it's not the Eagles. It's just Eagles.
Yeah, that's what I did to get you all teed up. I love it. I got to tell you something. Doug Cass, you know, I've known Doug. I met Doug in 1997. And Doug has obviously been a prolific investor and a prolific writer. And I think he exists to do that, to help people understand how markets work and that sort of thing. And he writes at thestreetpro.com, and there's just lots of great nuggets there all the time. But, you know, it's about, and you just mentioned Andrew Ross Sorkin's book, 1929. I mean, like this stuff, it just repeats and repeats again, and just change the names and change the numbers and, you know, change the people. It's the same stuff.
You're deep into that book, and I'm sure there are things in there that are frightening you. And that's a word that I'm choosing to use because of some of the parallels and some of the comparisons and some of the corollaries and some of the things that were happening there, just in the same type of parlance, the same type of language being used, but again, different vehicles. But again, it's history repeating itself.
Yeah, the book's great. I mean, you know, a couple of things. I mean, I know you guys have been hearing about, you know, the the Smoot-Hawley Act. I just changed some stuff up there, and that was
Fred Smoot played. I know Bill knows this. Fred Smoot was a defensive back. Played for the.
You just said Redskins.
I think I'm allowed to say Redskins because that's who he played for.
You can say.
Well, no, I mean, I'm not trying to.
Well, we still have the KC Chiefs. I mean, like they just won 28-7. They actually beat the Redskins.
Yeah. Well, no, they beat.
Why is it that Washington has to be the Commanders and the Kansas City Chiefs?
Listen, I don't understand a lot of things that go on. You know.
Well, listen, we like to be respectful. If you are, if you are of a certain, nationality or whatever, and you don't like the way that others are referring to you,
I didn't realize that Smoot played for the Vikings for a year.
Okay, so Smoot-Hawley Okay, this was a tariff act, and the guy from Bueller. They were raising tariffs right into an economic depression. And what's interesting about the book also is that Wall Street was lobbying into the crash because they had high margin rates. We've seen this before, right? So investors, it became a mania, and they were borrowing money, like crazy to, play the markets. And, Wall Street wanted them to lower interest rates, right? To make, capital more accessible to support this behavior because they were worried about a downturn. But, the regulators wanted to raise interest rates. We've heard this before, right? And so I don't know. It's the same shit over and over again. But
what Andrew will point out, and we'll end on this note. By the way, Jacob is pointing out that the reason why you can use one and suppose the other, because one of them is a slur, and Jacob is correct. So thank you for that, Jacob. And then Cece is pointing out that Fred Smoot was on the Vikings, and he's using air quotes, love boat. I'm not sure exactly what that means, but thank you for that, Cece. Now, quickly, what Andrew points out in his book and in the interviews is that the Fed was basically 15 years old or so when 1929 was taking place. I think the Fed was created in December of 2013. So they were relatively young, and I think they were terrified of their own shadow, and they were scared to do the wrong thing. So I think the infancy of the Fed probably contributed to a lot of what went on back then as well.
Yeah. A lot of stuff. It reads like a novel, by the way, but sure. A novel that ends.
Well, Andrew said that I can portray somebody in the movie.
No, I told him we're going back.
He said it on the Fast Money when he was on the other night.
He did? Okay, because the email, Andrew's going to come on the Risk Reversal podcast soon, and the email, I said, could you play Senator Glass, who is this old crotchety senator from Lynchburg, Virginia, and he was all over all these.
I'd have to work on my Southern accent.
You'd be fine. And he's all like banged up guy. He's like,
I don't know what that means.
Old age is just like breaking him down and stuff like that. And then when, so he was
constant pain.
Yeah. So when FDR won in 1932, FDR really wanted him to be the Treasury Secretary, but he was 71 years old. He was very sick, and his doctor didn't think, he thought a cabinet position would basically kill him. I haven't gotten to the part I haven't gotten to the part where he makes it or not.
I think he's probably died since then.
Yeah, but the idea was that FDR wanted to have somebody with like a lot of gravitas, as it meant to, you know what I mean?
Jacob is saying, Guy will watch My Cousin Vinny on a loop to get the Southern accent. That's very funny, Jacob.
That's good. Do I amuse you? All right, should we get out of here, Guy? This was fun. We covered a lot of ground here.
I always have fun.
You do have fun.
But I'm wearing my brown, like this is a quarter zip. Apparently, it only zips a quarter of the way down.
Jumper. It's like a zip jumper.
By the way, we should have. Speaking of British people, we should have Wilford back. Wilford, we did a podcast the other day. I think Vinny was asking me. I think Vinny said, "Who is the best CEO in the financial services space?" And I immediately said Terry Duffy. I didn't even hesitate.
Yep.
Of course, Vinny said no, but
he's not saying he's not a good CEO.
No, but he said no. But then Wolf saw that, and he thought it was, as the Brits would say, he thought it was brilliant.
Yeah, it was brilliant.
I like Wilford.
He's the man. He's
a handsome man too,
and a great look. Yeah, he's great looking. He's tall. He's got a great accent.
He's got good teeth. I mean, I don't know what the happened there. I guess they had money for orthodontists in the Wilford.
You've heard that expression that the English have summer teeth.
Summer here, some of there. Yeah.
All right.
I've made jokes on Fast Money about
not good. You hear from our
no, I don't care. I mean, don't bother me.
English friends. All right. You and I are going to be
back tomorrow.
We're back tomorrow. It's Wednesday. It'll be 11 a.m. You had a podcast with Liz Thomas, of SoFi, and the Risk Reversal podcast feed. Mike Wilson is going to be sitting in with us live. That's Mike
3 o'clock tomorrow. We're going to be like
during I wonder if we should just broadcast that live with Mike. Maybe
I don't know. Amanda can be the
maybe we'll do that. Maybe we'll restream it and then we'll put it on
wow, that sounds,
and then we'll have it drop in the podcast feed tomorrow. Maybe we'll do that, Amanda.
Drop it like it's hot.
Fun, Jacob. Yeah. Drop It Like It's Hot, like Papa John's. That's in the Pink Pony Club by what's her name? Chapel Roan. She was a big hit this last year.
You know, that song it's like an anthem for people.
Oh,
like
they love it.
I was at a wedding recently and they played it. People lost their effing minds.
She's a very, very talented musician. And it's a fascinating story. You know, she blew up, I want to say 2 summers ago. And
okay.
Her music.
Can I tell you something? I hear Bill.
Her music.
I hear Bill laughing in the background, and you know why?
Why?
Because it was the delivery. So
yeah,
it's totally right, Bill.
You know, totally he's a comedian. He's a comedian. You amuse him. So,
no, but did you hear him, Bill, laughing? That's fantastic.
The summer before last, the summer of 24, she comes onto the scene. She's got this whole thing. People can't figure out whether it's just a shtick or not. But if you go back, she was playing these same songs in these tiny little venues with nobody there like 2 years before. Her record label had dropped her. And it's a great example of perseverance, believing in yourself, guy. You know, keep working at your craft. Sooner or later, and this is Bill for you, and sooner or later, people appreciate it. Like, you know, someday there's going to be, you're going to have your own Netflix special, right? And we're going to say that we were your inspiration and we deserve most of the credit. Don't you think we'd say that?
I don't know about that. I can imagine what Bill would say.
A bit of
and he'll say something like, you know, I was a struggling comedian at one point, and
all right, this is great.
I had to work with these 2 friggin' old bastards.
All right, so look at this. CC just puts this in our chat. Look at Nokia. It comes out NOK.
That's Nokia.
Yeah, which was also a poster child in the bubble. This is going back. So it just rallied 20% in a straight line.
That makes sense.
Nvidia.
Why wouldn't it?
Nokia shares rise as Nvidia to take a $1 billion equity stake. Okay. So this was a stock that had a market cap.
By the way, this stock has done nothing for 15 years.
Yeah.
Legit.
So here, I'm going to just pull this up in US dollars here. So right now, up 20% is a $40 billion market cap, $7 billion in cash, $5 billion in debt. That's one way to get this balance sheet sorted out.
I mean, you got to admire. I mean, Nvidia is just going to take a stake in everything, and then, you know, all these companies. There's a brilliance to it.
Well, you know, it used to be if you wanted to bet against Nvidia and their technology and losing market share and you know, seeing strain on their margins and all that sort of stuff, it was very much a bet against Nvidia. Now it's becoming a bet against OpenAI, against Nokia, against, I mean, the list goes on and on. You know, AMD through OpenAI's investment in an AMD and Intel. I mean, think about it. The list goes on. And people are always looking for ways. You're going to hear people say Microsoft's been a great buy because of the stake that they have in OpenAI. Well, now because Microsoft's gained $2 trillion in market cap, their OpenAI investment worth $150 billion is a rounding error. You know what I mean? It's not a pure play on anything. If you're
I'm reading, I apologize, and I'm not gonna attribute this to anybody. So CC talked about the Fred Smoot love boat. Smoot and other Viking players rented a boat on Lake Minnetonka, which I think that's where Butters goes, and hired hookers for a sex party. Allegedly, Smoot organized it. I will not read the next sentence because I might blush.
I mean, I'm blushing just with what you just said.
But I never heard that.
All right, kids, stay in school. Don't do.
Lake Minnetonka sounds like very Disney World.
It sounds like Lake Winnipesaukee in a way, but that's
in New Hampshire.
Yeah. All right. I think everyone's getting sick of us. We got stuff to do here today. Market will never go down again, unchanged. The Nasdaq 100 is up 35 basis points. The S&P is unched. But to Doug's point earlier, Tesla and Microsoft and Nvidia up nearly 1%. That's kind of helping the Nasdaq here. The thing that I'm keeping an eye on, again, not to beat a dead horse, is Celestica after the close. Seagate reports. Okay, so this is a storage name, and we've talked about it yesterday. I mean, one of their biggest customers, or a couple of their biggest customers, are Dell, Lenovo, Microsoft, HP. So let's see what happens there. STX. You know, STX was my preferred lacrosse stick back in the day, guy. I don't know. If
it was. Did you string yours? What do they call it? Stringing your stick?
Yeah, I was not to I was good at it. And all my teammates, whether it was in high school and in college, a lot of them paid me to do this because I had a certain thing. And I'll tell you what I did.
So wait a second. You were on a team with teammates.
Yeah.
And they had to pay you to man.
They paid me $20. It took me like an hour or two to do it. And it was also so really quickly. So I grew up in Syracuse, New York. I graduated high school in 1991. There was these two players that you know who they were, Paul and Gary Gate. They changed the game. They were
from Canada
brothers. They played at Syracuse. They were from Canada. No one knew who the heck they were when they got there in 1987. In 1988, in 1989, and 1990, Syracuse lacrosse did not lose a single game. They won 3 consecutive national championships. It was like they were like our idols. So my sisters went to Syracuse, and one of them dated a guy on the team or whatever. And Gary gave a stick or a head to me through them. And he used to string all of his own sticks, and he used to string for the guys on the team. And I ripped off how he did it. I had to deconstruct it. Okay, because there was these 4 leather things, and all this nylon, and
deconstructing gate. That should be a book.
I deconstructed it, and I just learned how to do it the way they did, and they were awesome. All right, one last thing. So my dad sent me this last night. My dad played lacrosse in Syracuse in the early '60s.
They had those bamboo sticks.
They did. I have them. They're amazing. They're not bamboo. They were made out of wood, and they're like leather, rawhide, and stuff like that. All right. You want to hear what Syracuse's schedule is this coming? Rafus and I already emailed about it. You ready for this? So you ready for this? Where the hell is this? Okay. So they have BU at home, St. Joe's at home. Those are 2 layups.
Win-win.
Maryland at home. It's going to be dicey.
Maryland, I'll tell you what, they reclaiming the glory of Maryland lacrosse.
They lost to Maryland in the semis that last year. You ready for this? At Harvard, at Princeton, at Penn, at Hopkins, at Air Force, at Denver. 6. That is like the gauntlet.
At.
Then at home, and maybe you and I'll go up for it, March 22nd, Georgetown is at home.
Yeah.
Duke is at home. Then they're at UNC. Then they have UVA at home. Then they have Colgate at home. And then they're at Notre Dame. They are basically playing all of the Ivies and the Ivy Plus and the ACC.
Gauntlet.
That is the hardest schedule I have ever seen.
Battle tested.
History.
They need Rafus back. And the little kid that worked for us. I mean, he was a tiny little thing, but he was good.
He went from Princeton to Syracuse. He's a great player. Great guy. All right.
I mean, a little person though.
That's I would have.
Well, he's not that little. His ass. Lacrosse needs nasty people like me.
They got plenty of them. Have you seen the PLL?
It's a violent sport, man.
Yeah, I love this. I don't know if you saw.
This is way too nice.
This was in the New York Times. Trump's China deal may avert a crisis of his own making. The Trump administration is handling a potential deal that may return the U.S.-China relationship to where it was before.
I think we led the show with that.
I know, but I didn't see it. I love this. I mean, I don't love it. Listen, let's get a deal. Let's protect our IP. Let's work with the Chinese. You know, Doug had a great. Maybe we'll put it in the show notes. I think.
Speaking of IP,
you have to go.
Yeah.
At his age, he has to pee. That's how he says it. All right. But there was one note, and I want to put this in there, and maybe Doug can put it to the top of our thing. We'll put it in the show notes. It was basically from I can't remember who it was from. He shared this article basically saying that the bubble in AI, what makes it singularly dangerous is that every one of these companies that is spending $100 billion a year, or $75 to $100 billion a year to build out this data centers and the infrastructure, they're all going after the exact same thing, which we've highlighted: AGI. That's it. And then it's super intelligent. They're all going for the same prize, which ultimately means when they get there, they're all going to be looking around and saying, well, holy shit, we just spent $1 trillion. We all have the same thing. And then it's commoditized. And then the price of commute comes down dramatically because that's the only way you're going to get customers to use it. So the fact that all of these investors in the private markets, all of these investors who are loading into like Celestica and all this stuff that are like literally the lowest guys down the totem pole. You know, you have NVIDIA that's got 75% gross margins that are coming down because of competition. And then on the low end, you have Dell and you have these contract manufacturers who have low teens. At some point, it's going to be last in, first out.
LiPo.
Yeah, you're not
Japanese accounting measure.
You want to be left holding the bag of the crappiest names that are totally commoditized that basically make no money, like on the product.
Speaking of holding the bag, when I walk the dogs, I'm the jackass that has to hold the shit bags.
I mean, who do you expect? Do you want to put it in your dog's mouth?
No,
like the bag. You ever see how the dogs hold their own?
You know what some people do, and I got to get a kid from Georgetown's calling me at noon. Some people walk their dogs. They get their shit bags and then they put them on the side of the road.
That's disgusting.
WTF?
You want to hear this? We're walking down Fifth Avenue the other day, Sarah, me, and our dog Dodger. And it's like the time where a lot of the shops are like opening up. Maybe it's like 9:30, 10 a.m. I can't remember exactly what it is. And in New York City, for those of you who don't live here, you put your big garbage cans out and the big things come overnight and they take the garbage, they put the empty cans back there. And then the people in the stores or the shops or the restaurants, they bring them in the morning. So this woman, she's probably like 60 years old and she's going into a shop. It's like a women's clothing shop. And we see her go and get the big garbage can and she dumps it out. She like literally dumped, like there was a bunch of garbage still in there. She just dumped it on the street. And my wife and I, not like we're like the garbage police or anything like that. We're like, lady, really? Like, you know what I mean? Like, we're like, really? Like, there's just like empty bottles and like pizza and like garbage in there. And we're like, really? And she goes, well, you got a dog that pisses. I was like, yeah, dude, we pick up the dog's crap. What do dogs make this world better. You know who don't make this world better? 60-year-old ladies who just dump garbage all over the street in Manhattan. Named Karen. So, yeah.
I mean.
So, Sarah, these super annoying people that are on the street corners and you think they're doing good by raising money for this charity or that charity. And they're usually like these spunky kids and everything. And it's a total scam. They get paid like, 50 cents on the dollar and probably none of the money goes to the charities anyway. And they bug the shit out of you. And I have the thing, I always have my AirPods in there and they try to talk to me. I'm like, I just point to it like I'm on the phone call. So Sarah is just such a sucker. She'll talk to these people. And then she was like, I'm really in a rush. I'll come back and blah, blah, blah. I'll hear the whole thing. And she goes, what was your name again? It was like, she just looked at him like this. Oh, I thought it was Karen. To this day, she's still pissed off about that. It took a beat for her to figure that out. All right. So Liz Thomas and they're in the Risk Reversal podcast feed. You and I are going to be back tomorrow morning, 11 a.m. on the market call. We have Mike Wilson in the afternoon. Maybe we'll put that on live. So check out our YouTube channel. It's at least going to drop on the Thursday morning. That'll be fun. Guy Adami, it's been a pleasure. Thanks for being here, people. Thanks, Doug, as always, for all your contributions. We'll see you tomorrow.
Later, Pete.